Okay, good afternoon. So continue our discussion on the break-even point. The next topic would be profit planning. Okay, so what if the company would like to generate a certain profit? How much should they be able to sell? Okay, how much and how many items should they be able to sell for them to be able to achieve a certain level of profit? Okay, now still we will make use of the formula, okay, in order to compute for the desired sales. So the desired sales would be the fixed cost plus the desired income divided by the contribution margin percentage. Okay, so let us use the same information as what we had earlier, only that we will add the desired profit. Assuming that the desired profit is also 120,000. Okay, so using our earlier example, the desired sales now will be computed as follows. So you have the fixed cost of 120,000 plus the desired income of 120,000 divided by 60%. Okay, so therefore the desired sales for them to be able to generate 120,000 in terms of net income is 400,000. Okay, let us try to prove. Okay, so you have the sales, which is 400,000. Okay, less the variable cost, which is again at 40%. So that's going to be 400,000 times 0.4. So that would be 160,000. So therefore, the contribution margin now is less 400,000. That's going to be 240,000. Okay, so that is the contribution margin. We less our fixed cost is 120,000. So therefore, the net income is 120,000. Okay, so the company should be able to generate a revenue of 400,000 for them to be able to generate income of 120,000 for this part. Okay, so that is how we use the simple formula for the break-even analysis to find the desired or the sales that would generate for the company the desired net income. Okay, now variation of this, what if it's there's a tax component? So what you do is just from here, okay, you gross this up, okay, gross this up to find for the net income before tax. Okay, so let us say that we will be using this, except that there is a tax of say 30%. Okay, so how will this impact our calculation? So again, the desired sales is equal to your fixed cost, which is 120,000, plus the desired profit of 120,000. But remember, this is already net of the tax, and the tax is 30%. So 1 minus 30% is 70%. Okay, divided by 60%. So therefore, that is 120,000 plus, so 120,000 divided by 0.7, 171,428.57. Okay, divided by 60%. So therefore, plus 120,000. So that's going to be 291,428.57 divided by 60%. So therefore, the answer is 0.6, 485,714.29. Okay, now since it's decimal, we might have a small difference later on, but we will still try to prove. Okay, so therefore the sales here is 485,714.29 less the variable cost, which is 40%. Okay, that times 0.4. So therefore this is 194,285.71. Okay, so therefore the contribution margin, which is 60%, is less 485,714.29. Okay, that's 91,428.58. Okay, so less the fixed cost, which is less 120,000. So therefore less 120,000. Sorry, 291,428.58 less 120,000 of fixed costs. So therefore, your net income before tax is 171,428.58. Okay, less the tax, and that is 30% of net income before tax times 0.3. So this is 51,428.58. So therefore, less 171,428.58, this is 120,000 net income. Okay, so this is your net income before tax. Okay, so that is how we made use of the break-even point formula, modify it a bit to compute for the desired or for the sales that we need to generate for us to produce the desired profit of 120,000. This is already after tax. Okay, so it's very simple and the computation is very straightforward. Okay, I hope you'll be able to gain something from this lecture, and please watch out for the next lectures. Thank you very much. Bye.